Next chapter, Bill of Exchange. According to the Negotiable Instrument Act 1881, a bill of exchange is defined as an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. Features of Bill of Exchange. A Bill of Exchange must be in writing. It is an order to make payment. The order to make payment is unconditional. The maker of the Bill of Exchange must sign it. The payment to be made must be certain. The date on which payment is made must also be certain. The bill of exchange must be payable to a certain person. The amount mentioned in the bill of exchange is payable either on demand or on the expiry of a fixed period of time. It must be stamped as per the requirement of law. Parties of a bill of exchange. There are three parties to a bill of exchange. Drawer, drawee, and payee are the parties of a bill of exchange. First, drawer. Drawer is the maker of bill of exchange. Drawer is the maker of the bill of exchange. A seller or creditor who is entitled to receive money from the debtor can draw a bill of exchange upon the buyer or debtor. Drawer is the seller of goods. Then drawee. Drawee is the person upon whom the bill of exchange is drawn. Drawee is the purchaser or debtor. Drawee is the buyer or purchaser. Then payee. Payee is the person to whom the payment is to be made. Drawer, drawee, and payee are the three parties to a bill of exchange. Drawer is the seller. Drawee is the buyer. Payee is the person to whom the payment is to be made. Next, maturity of bill. The term maturity refers the date on which a bill of exchange or a promissory note becomes due for payment. In arriving at the maturity date, 3 days known as days of grace must be added to the date on which the period of credit expires. Instrument is payable. Accounting treatment. For the person who draws the bill of exchange and gets it back after its due acceptance, it is bills receivable. For the person who accepts the bill, it is a bills payable. For the person who draws the bill of exchange and gets it back after its due acceptance, it is bills receivable. For the person who accepts the bill, it is a bills payable. Journal entries in the books of drawer or journal entries in the books of seller. Drawer is the seller. Journal entries in the books of drawer. Case 1. When drawer retains the bill till maturity. First entry, drawee account debtor to sales account for recording credit sales of goods to drawee. Journal entry, drawee account debtor to sales account. Second entry, bills receivable account debtor to drawee account. Narration, received acceptance of drawee. Bills receivable account debtor to drawee account. Third entry, cash or bank account debtor to bills receivable account. Narration, drawee met his acceptance on maturity. First entry in the books of drawer, drawee account debtor to sales, that is on the date of sales. Then second entry, bills receivable account debtor to drawee account. Third entry on the date of maturity for getting cash from, for receiving cash from drawee, journal entry, cash or bank account debtor to bills receivable account. Next, journal entries in the books of drawee. First entry for the purchase of goods on the date of purchase, purchase account debtor to drawer account. Second entry, drawer account debtor to bills payable account. Narration, accepted bill drawn by drawer. Third entry, bills payable account debtor to cash or bank account. Narration, met acceptance on maturity. First entry in the books of drawer or seller, drawee account debtor to sales account. Second entry, bills receivable account debtor to drawee account. Third entry, cash or bank account debtor to bills receivable account. Then journal entries in the books of drawee or buyer, purchase account debtor to drawer account, drawer's account debtor or drawer account debtor to bills payable account. Then last entry for making payment on maturity, bills payable account debtor to cash or bank account.